bring in Christian Wetherbee, who just blew me away with a great railroad report here about 3 weeks ago. And we're going to talk about the railroads. I got my iPad here. We're not going to show it, but I got my hurricane tracker and innovation. My whole take on the railroads is essentially all of our stereotypes about the railroads, including Warren Buffett's stereotypes, are wrong. What's the distinctive feature of the new railroad industry?
Yeah, I mean, I think ultimately it comes down to profitability. This is all about a business that has pricing power. It's had it for the last 5 years, and it's holding on to it even through ups and downs in the overall economy. So you have volumes ebbing and flowing, but you do have pricing power, and that's really been the consistency of the business for the last 5 years.
When I last talked to you, you blew me away with the statistic, how much is coal? When we say the railroads, some of us think of Amtrak stuck on a track somewhere. That's not it, is it? It's coal.
Absolutely. Coal is about 25% of the rail industry's revenue. And, you have a little bit more heavier weighted for names like CSX. But in general, it's north of 20% across the board for each individual rail.
It's a break exclusive. I love when Christian Weatherbee's on because we get to look at cool railroad video, which is just way cool. Let's look at a chart, the new rail productivity. And I was surprised. I hope this is accurate. U.S. rail miles. They just changed in the 80s. First of all, why did it plummet in the late 1980s?
Well, you've gone through post-deregulation, which was in 1980 under the Staggers Act. You've seen a significant amount of consolidation in the industry. So we've gone from, north of 25 railroads on a Class 1 basis in deregulation to about the 7 that we have in North America right now, which includes the 2 Canadians and the 5 that we have here in the U.S.
Is it oligopolistic, or is there some real competition?
Well, there's competition. It's more on a geographic basis. You have 2 Class 1s in the eastern half of the U.S., you have 2 Class 1s in the western half of the U.S., and you have the 2 Canadians competing up north and as well as in the U.S. So there is competition. It's more on a geographic basis, though.
It's on a geographic basis. My viewers and me are going, yeah, right. Do they really compete in the East? Who's in the East?
So in the East, you have CSX and Norfolk Southern.
Do they really compete?
Absolutely. There's a significant amount of traffic that is competitive amongst the individual rails. And you have to remember, this is a mode of transportation that also competes with truck at the end of the day.
What is the distinction between Mr. Buffett's purchase of a railroad and his purchase yesterday of a bank? Those are 2 very different businesses. What does he like about the cash flows of Burlington?
Well, when you look at a company like Burlington Northern or railroads in general, this is the type of industry that a guy like me can really get my arms around. Banks is a little bit too sophisticated for a baseline transport guy like myself. But I think in general, you see cash flows from very stable businesses, particularly for Burlington. It has a great agriculture franchise. They have a very solid coal franchise. And those are a little less economically sensitive than some of the other modes of transportation that you'd see, whether it be trucking or some of the other modes out there. So, good baseline recurring cash flows that you see from those companies.
Elegant chart here. Let's bring it up. I was surprised by this differential. I'm aware of it, but more so, there's the S&P, and there is the juggernaut. I mean, is this like, am I late to the party if I buy the railroads here? Or is that a trend persistency higher into the upper right, as Mr. Gartman would say?
Yeah, I mean, we've seen the railroads post earnings that have beat the S&P 500 over the course of the last decade. So it's been a very consistent performer for the rail industry, and that really goes back to the pricing that we talked about before. That being said, where valuations stand right now, and you have to remember, we've taken down our numbers a little bit in a report that we did put out a couple weeks back. We still see very solid opportunities here. The group is trading just above 11 times, which is about 2 multiples below their long-term historical average, which includes periods even before pricing power.
Okay, let's translate that. They're trading at 11 times earnings. And the normal, when you say 2 times up, is 13 times
13
earnings.
to 14 times is the long-term historical average for railroads. So at 11 times, you have fairly reasonable valuations, in our opinion.
Lowe's with a share buyback. Somebody else this week, CVS, I believe, with a share buyback. Are these the kind of people to deploy cash to shareholders?
Absolutely. So when you think about all the consolidation we talked about before, you really don't have all that many opportunities to do things like M&A. And so you're going to see significant CapEx, but you're also going to see dividends increasing in CapEx and buybacks increasing as well. So there will be returns to the shareholders, and free cash flow yields are starting to improve.
Single best buy right now?
I think right now we're continue to recommend Union Pacific. They have long-term legacy contracts which are repricing over the next several quarters, and that should give them a very good volume-neutral boost to earnings next year.
And do I understand that if we do get nominal and even real GDP up, that's got to benefit these guys? It's immediate leverage to profit?
Absolutely. This is a group that's going to grow at a multiple of GDP going forward, or at least GDP plus when you think about it relative to other modes of transportation. So it definitely is good.
Very good. Thank you for the train pictures. Christian Wetherbee, Citigroup, Union Pacific, Single Best Buy, Alan